with Maxime Bichich, who is at the University of Buffalo. So before I even start with this talk, I want to go through how this project came to be. So it is not about kind of the various Bitcoin ETFs that have now been, I guess, legalized, but rather going back almost a year and a half now, I had some conversations with a couple of fintech startups, and two in particular really drove this idea of this project home. One of them was looking at how do we hedge some of these products that exist in decentralized finance, these novel ideas that were created, and they were trying to figure out, is there a way that we can get those high returns but minimize the drawdowns? So can we create a hedging instrument for this? And the other one was saying, actually, we can treat some of these decentralized products as types of options, as very exotic options. So taking those two ideas together, Maxime and I started to look at, well, what is, if we treated these as options, what would be the way to hedge it? What is the delta hedge? What is the gamma hedge for these products? And to really do that, we need to know what is the implied volatility. So that's kind of what generated the interest in this project. But to really get into it, first, what is decentralized finance? So it's the idea that we use blockchain technology to provide financial services. This could be lending, this can be borrowing, can be insurance underwriting, or for the purposes of this talk, it can be trading. It can act as an exchange. And this is all being done without using traditional financial intermediaries. So in DeFi, in dollar-denominated terms, there was a 90x growth between January 1, 2020 and January 1, 2022. That 2022 date was chosen fairly particularly because just in spring of 2022, we had the so-called crypto winter, where there was a massive collapse in a lot of these crypto assets and decentralized companies. I will say that first company that was trying to pitch the idea of how do we hedge these decentralized products before the collapse, before the crypto winter, they said no one would call them back. No one saw the need to call them back. You made 10% returns in a week, so what's the need to hedge? And then when everything collapsed, they started getting calls. That's when everyone said, oh, we actually want to be able to control the risk that exists in these products. So the peak market capitalization was nearly 180 billion. Today, I looked up yesterday, it was back around 75 billion. So it is significantly smaller than it was back January 1, 2022, but it's still a not insignificant sum of money in decentralized finance.
Zach, I didn't ask at the beginning. Can we interrupt as we go along, or do you?
Yeah, please feel free to interrupt at any point.
So I've got a question already on the previous slide. Yeah. Didn't we have other crypto winters before, like before 2020?
Yeah, so cryptocurrencies have had a number of booms and busts, let's say. What made kind of the crypto winter in 2022 particular to decentralized finance is it's when we kind of, originally we had Bitcoin, then there was kind of that ICO boom and bust where those turned out to primarily be scams. Then during the pandemic, with the introduction of really smart contracts as a more sophisticated idea, we had much more sophisticated companies, much more value in these in this industry than previously. And this is really the crypto winter, was the collapse in a lot of these smart contracts. So that's right. Kind of one of the key differences.
So my question is, if there's a boom and bust history, Like think of another boom and bust industry like oil, right? Everyone knows you need futures, you need hedging instruments. And this industry, blockchain technology related industries have had that kind of thing. Why didn't they think they needed hedging instruments? Do they have that short a memory?
They have a very short memory, and a lot of the people that are during the pandemic that were getting into cryptocurrencies were doing so really in a gambling mindset, not in an investment mindset. So from that perspective, if you're going to the casino, you're not going to look, how do you hedge your blackjack bets? You're just going to place the bets and hope you strike it rich.
I see. Well, it is probably a discussion for a different time, but if ever there was an corner of finance that I wonder if it doesn't lend itself to a gambling casino type analogy. I think none of them do, but this one in particular seems like a very bad connection because it's very manipulated. I mean, it's not really stochastic at all in some tellings, at least.
Correct. Yes.
I've got a question about the numbers. So you say 90-fold growth, which would imply the market cap in early 2020 was only about 2 billion. And that seems way too low to me. And was it really only 2 billion at the beginning of January 2020?
So it's a distinction between decentralized finance and cryptocurrencies more generally. So decentralized finance, again, is really the idea of these companies that use smart contracts for lending, borrowing, trading, insurance underwriting, etc.
I see. So Bitcoin is excluded then, is that right?
Correct.
Okay, got it. Thank you.
Other questions at this point? So I'm going to be focusing on the trading aspect, which in decentralized finance occurs through what are called automated market makers. Generally, these are going to be abbreviated as AMMs, and these are a decentralized approach for creating a financial market. The way they do this is they create liquidity pools of assets. So any individual can add their assets to this smart contract, and in exchange, they get a fraction of the fees collected from the market-making operations. But rather than traditional market making, which use quite sophisticated procedures, they just say there's a mathematical formula that balances the reserves. So in this talk where we're focused on the constant product market maker, it means that the product of the assets that they have should be kept a constant throughout all trading, through all swaps between these assets. So it's very simple mathematical formulas that are used in order to make these markets. And as I mentioned, any individual can pool their resources, which means any individual can earn the fees from the trading activity and therefore can really take advantage of really being the financial intermediary. So the goal of this talk is to analyze these automated market makers and figure out what is actually the fair price for this liquidity token, for pooling resources into the AMM. Then if we know here's a formula for the fair price and here's the current price of this product, we can compute what is the implied volatility. And therefore we can start saying, what are the Greeks? What is the delta? What's the gamma? How can we actually hedge this position if it exists as it does exist in the real market? So to go a little bit deeper into what AMMs are, again, they employ this constant function setup. So there's some utility function. We're just going to focus on the two asset case. We have asset X and asset Y. And throughout this talk, we're going to assume asset Y is your numeraire. So it's a stable coin, whereas asset X is something something random, something stochastic, a risky asset. So if the AMM has reserves XY and someone wants to swap delta X for delta Y, it must be done in such a way that the original utility U of XY equals the final utility. So the trader is exchanging delta X, giving it to the AMM and getting delta Y in exchange. So this is the utility of the AMM itself, not of any individual trader. So from this formula, you can always solve for what would be a fair exchange. This also allows us to.
Can we go back to the formula for a second? Just, oh, here it is. Yeah, that formula implies a lot of symmetries in the kind of function U has to be, doesn't it?
The function does not need to be symmetric. It's just a function of two inputs. There are certain properties that we do need to put on it so that there does exist a unique solution to this.
Like,
So if
I mean, for one thing, it has to, does it have to treat the variables X and Y in the same way? Or?
No, it does not.
Okay, sorry, just not used to this.
I
So
think
really,
that
geometrically,
equality implies a functional relationship between delta X and delta Y that make that equality correct.
Yeah, it does. I'm just trying to figure out on the fly what it
so
is.
what it's really doing is, and I hope you can see kind of this drawing, is we're creating what they call a bonding curve. So you just say, if we're currently at X and Y, which is this point here, any trade just moves us somewhere along this curve.
Mm-hmm. Yep.
Okay, thank you.
So a market maker would normally want to either collect a fee which is separate from this, or alternatively move up to a higher indifference curve. Is collecting a fee separate from this allowed, or?
So this is the equation without fees. We will add the fees in another slide.
Great, thank you.
Could you give us, just so we have something to work with in our conceptual understanding, some paradigmatic examples of X and Y?
Yep, so you can think of X as being Ethereum and Y is USDC, is a stable coin, one of the few that has stayed stable over a long period of time. But generally, we can think of X as any risky asset and Y as a stable asset.
Okay, thank you.
Good, thank you.
So then with this swap, with this utility function, we're able to say, what is the marginal price? So if you go to the AMM and you ask, what is the current price of X in terms of Y? It's just the ratio of the partial derivatives. Very easy to solve this just doing implicit differentiation. So this is, again, with asset 2 as the numeraire. And then when someone is depositing or withdrawing funds from the AMM, they do it in such a way that the price is unaffected. So if I wanted to get to add my assets to the AMM, I do it in such a way that the price does not move. If I've already added liquidity, when I withdraw the liquidity, it's at the current price. So that way, swaps change the price, adding and removing liquidity keep a constant price. So if we look at the depositing problem, you deposit a new, what's called an LP or liquidity provision token is minted. And when you own this token, you get a fraction of all the fees that are collected from trading. The way that this has been done in practice thus far is taking a fraction of the incoming asset. So in the prior example, we had delta X going into the AMM and delta Y going to the trader. So gamma of delta X is being taken and distributed to the liquidity providers before being used for this transaction. So the liquidity providers are getting some amount, and essentially that moves them up this indifference curve.
Okay, so could you, again, using the example of Ethereum and US coin, could you illustrate
Yep.
a model transaction?
Yes, so let's, ignoring the price impacts that would happen from this function, let's say we're trading one Ethereum for roughly $2,000. So when we do that, we give one Ethereum to the AMM. From the top, let's say about 5 basis points of Ethereum, so 0.0005 Ethereum, are taken off and distributed to the liquidity providers. And the other 0.9995 Ethereum are then converted to whatever the correct number of dollars would be.
Great, thanks.
So while we're taking this off of the incoming asset, in theory, we could do other constructions. We could take it off of the outgoing asset. So in that quick example where we traded Ethereum for dollars, that would be taking the fraction of dollars off of it instead of the fraction of Ethereum. We could do it on the numerator, so always take it off the dollar side. We could always take it off the risky asset side. There's a number of different possibilities, but for the purposes of this talk and for when the paper is completed for the paper, we're going to be using it in the way that this is done in practice so that this is most applicable to the real world. So beyond just saying we have this AMM is a smart contract that exists on a blockchain, which means that these are a smart contract. They are just a piece of code that anyone can interact with. Because these are on the blockchain, it means that the transactions are only being processed at these discrete times. They are not being processed continuously in time. So the prices are only updated at every, we're going to say, delta t. Bitcoin has kind of a stochastic random delta t based on the proof of work, but more recent, more modern blockchains actually work on a fairly fixed interblock time of delta t. So proof of stake, you're able to have this as a very consistent interblock time. So for instance, the Polygon blockchain, delta t is roughly 2 seconds. When I looked at data over the course of a couple of months, the variability there went from about 1.98 seconds to 2.02 seconds. So there is a little bit of variability, but it is fairly consistent. Ethereum works on about delta t is around, at this point, 10 seconds. So there is variability based on blockchain, but within the blockchain, we can have fairly consistent interblock times.
So can I ask a question about
Yes.
that? So does that mean it's a batch system? So you collect the orders that come in, you wait, and then at some point you execute the orders, and then more orders come in, nothing happens until you decide to execute them again. And is that right?
That's roughly correct, yes.
Yeah, okay, thank you.
So because of this, we start with a price process PT, which is continuous, it's stochastic, but the AMM is only realizing the prices at these discrete times, PI delta T. So this is how we're really using this, and we're going to assume this constant delta T throughout. So constant product market making, which is a type of AMM, uses, I like to describe it as the log utility. So U of XY is just the log of X plus the log of Y. The way that this is described in DeFi is always as the product function. So it's f of xy equals x times y. That's why this is called the constant product market maker. It is exactly saying we are going to keep a constant product. But easily you put a logarithm around it, it is equivalent to the log utility. So from that perspective, coming from a more risk side of things, I am very comfortable talking about log utilities versus this quasi-concave X times Y product.
Is the repetition of the word function twice?
That is a typo.
Okay, thank you.
Yep. Thank you for catching that.
Thank you, Nick.
Yep.
I'm sure there are going to be other typos in here, and I apologize for them in advance.
That's just doing my job. Yeah, that's no need to thank me.
So there are, as I described, there are a number of different utility functions that are used by AMMs in practice. This constant product is by far the most popular. So it is used by Uniswap. It was V1, then it was V2. At the end of the talk, we will discuss V3 a little bit because there are some variations for that. But this is also used by Sushi Swap, Pancake Swap, etc. Do not ask me how they come up with these names. I have no idea. But essentially, generally, if you hear constant product market maker, that associates you with Uniswap, and Uniswap is by far the largest AMM by market cap, by volume, by market cap, by assets under management, all of that. So this is kind of the gold standard of what is being used, which is why it's the one that we focus on.
Presumably the names were developed to instill respect for the security and solidness of the market.
Exactly.
Yeah.
I was thinking more of the 7 deadly sins. This one's like gluttony. But sushi.
Sloth swap, gluttony swap.
Well, pancake swap, come on.
Yeah.
They were hungry.
Yes. So when we use this constant product, the pricing oracle is really easy. It is just the ratio of the assets. So the price of X in terms of Y is just the number of the numeraire asset divided by the number of risky assets being held by the AMM. So if we assume that our price process follows a geometric Brownian motion and we're under the risk neutral measure, so we just have dpt is pt times rdt plus sigma dwt for Brownian motion wt, then we can describe the number of units of X if we made this continuous in time would just be L times L divided by the square root of PT. Y is L times the square root of PT, where L is the square root of X naught times Y naught. This L is just how many liquidity tokens, how many LP tokens have been minted for this pool. So we can really keep track of, this is the number of liquidity tokens, this is the price, therefore we know at all times what are the number of assets in the reserves, if this was being updated continuously. Instead, we're going to just look at X I delta T, Y I delta T, because these are only going to be updated at these discrete time points.
So
But we
you
are
mentioned, sorry, I have a question. You mentioned there's like a liquidity pool. So does that exclude dollar as an asset then? So we converting like Ethereum to Bitcoin, or?
So we look at stable coins as being the equivalent of dollars.
Okay, so you okay, yeah, thank you.
Mm-hmm. So we are assuming that kind of the YT is in dollar denominated terms, XT is in Ethereum denominated terms. So if we look at the fees that are collected from these transactions, at delta T, we have I'm going to have some annotations here. We have gamma, which is the fraction coming that we're taking off the top. Then we have the price of the incoming assets when it's the risky assets, so the difference in what happened to the risky assets at block I. So we are up to xi delta t. We were at xi minus 1 delta t, but we're only taking those assets when this is positive. So if X is being added, we're taking a fraction, gamma fraction of those assets, and then we're valuing those in dollars. So we're taking the price and that's the value of the fees that we're collecting. If someone is buying Ethereum for dollars, then the dollars are coming in, the Y is coming in, and we're only going to collect the positive part from that. And then we normalize by the number of liquidity tokens so that we get the fees per token. And the reason that we can really say this is fees per token is these fees are distributed proportionally to the size of the contribution to liquidity. So we just say everyone's collecting some number of L tokens and dividing by L, that's exactly the fees per token. So the total value of the AMM and the fees are sufficient for considering individual positions. We don't need to really look at different people investing at different times. We can just say, what is L, what is X naught, what is Y naught, and we can describe the whole system. Which, if we look at it this way, and again, this is coming from conversations I had with individuals trying to actually sell these things, we can look at this depositing of liquidity as actually a purchase of a Bermudan perpetual option. So the idea is you can exit, you can withdraw your assets at any block. That's what makes it Bermudan, and it's discrete blocks. These fees are paid at each block until you have an exercise. And if you wanted, you could continue indefinitely. You could go to infinity. There is not some fixed maturity that this is run until. So it is a perpetual Bermudan option. And to purchase one LP token has the cost of 2 times the square root of the current price P naught. So we know what the cost today of this token is. We don't know what the actual value is of making this position. So we want to know what's the value at any block I, or in particular, if we exercise optimally, what would the value be today under this risk-neutral world?
So you've written it as if it's always exercised, or alternatively, the person keeps paying forever. Can they not exit and say, okay, I'm not going to pay anymore and I'll walk away from the option?
So you can walk, when you withdraw, when you exercise, you get back 2 times the square root of the current price. You're getting back the current fraction of the assets that you put in.
So you never want to walk away. You always either continue or you exercise.
Exactly.
Is that right? Okay.
Yeah.
Thank you.
So you pay up front, and at that point, all you're doing is collecting fees, and you can, of course, withdraw at a later time point.
Yeah. Thank you.
So if we look at this Bermudan option, we can look at a DPP formulation. So given that the current price is P, we as the investor have to decide, should we exercise and at this point get the value of 2 square root of P, or should we continue? And if we continue, we're having the discounted expectation of the continuation value. Basically, we update our price process, and we're also collecting some amount of fees. And one nice thing about how DX and DY are evolving, we just need to keep track of what are the prices, what's the difference in prices. So it's either P1 times 1 over square root of P1 minus 1 over square root of P naught, if someone is selling the risky asset for dollars, or square root of P1 minus square root of P naught if someone is buying the risky asset with dollars. So we have this DPP formulation, and we want to see, can we actually get a value for this? Can we find what is the optimal execution strategy? To do that, we're first going to say, can we get the discounted expected value of our fees? Because if we can do that, then we can make this continuation value much easier to work with. And because everything's nice, geometric Brownian motions, we can compute this explicitly. it's equal to 2 times 1 minus e to the negative 1/2 r plus sigma squared over 4 delta t times the square root of p divided by gamma star, where gamma star is this kind of ugly looking formula. But the key point is this gamma star is a constant with respect to the price. So it only depends on the interest rate R, the volatility sigma, and the block, interblock time delta t. So we're able to say, here's this constant gamma star, and we'll see why we're using the gamma notation for that in a second. But from this, we know, okay, we can plug this in for this f times f of the price process. And then we take the ansatz that we either should never invest in the AMM, it was always a bad decision, or once we've invested, we never want to exercise. We want to perpetually accumulate these fees. So if we take that ansatz and we look at what's the value of never exercising, then we get gamma times this infinite sum, which is equal to ultimately 2 gamma square root of p naught divided by gamma star. So everything kind of cancels it out really nicely, other than this ugly gamma star equation, which means our value would either be v tilde, this infinite collection of fees, if gamma is greater than gamma star, or we never would have bought this in the first place, 2 square root of p, if gamma is smaller than gamma star, because it's very easy to compare this to that stopping criteria. So we want to verify. If we assume gamma is greater than gamma star, then we're coinciding with the continuation value by construction. And it always happens that this continuation value is greater than the stopping value. So that's verified. If gamma is greater than gamma star, this looks correct. If gamma is less than gamma star, then we can compute the continuation value. And when we do that, we get something strictly smaller than 2 square root of p. So again, this verifies we would never want to buy in if we were to have stopped, if we were to have gamma smaller than gamma star. So we either never want to quit or we never want to join. Those are our 2 options. If you are working in this AMM, if you're in a geometric Brownian motion world, these are the 2 possible situations, and it's just based on what are the fee level that you're going to be working with. So if we look at this in practice, we're looking at, this is data from June of last year, from a Polygon blockchain constant product market maker. Delta T is 2 seconds, 5 basis points in fees. We just roughly estimated the risk-free rate as 5% annualized. And then to make this plot, we said, let's take the 1-day historical volatility, which we're computing this from minute returns. So that's how we get our volatility, and we plug it into this formula. We get our gamma star, and we find that the value is this black line versus the cost of actually pulling in would be this dashed red line. So the dashed red line varies between kind of $80 and $90 for 1 liquidity token, while the value, if you held this for infinite time horizon, that varies between kind of $150 to $300. So this looks like a really good decision if you are using the historical volatility. But what is the actual implied volatility? What's the volatility so that we get the equivalence between the value of this option and the cost of this option? This is the same thing as saying, what's the fee levels, or what's the volatility so that gamma star is equivalent to the fees gamma? And one interesting thing here is this implied volatility is independent of the initial price P naught and independent of the level of liquidity L. So it does not depend on anything about how much money is in this AMM or what the current price is. It's going to actually be a constant. If the risk-free rate is 0, then we know there exists a unique implied volatility, and we can compute it using bisection search. If the risk-free rate is positive, then if delta t is too large, and in practice this delta t bar is very large in comparison to these interblock times that are found in practice. But if delta t was too large, then there is no implied volatility. If it's small enough, we can set sigma bar to be this constant. And then we can say there's no implied volatility if gamma is too small, if it's too small compared to gamma star of sigma bar. There's a unique solution of exactly sigma bar if gamma equals gamma star. And there's exactly 2 distinct implied volatilities, gamma star 1 and gamma star 2, that are on opposite sides of sigma bar, or sigma 1 star, sigma 2 star, on opposite sides of sigma bar if gamma is greater than gamma star sigma bar. So we have kind of these 3 situations. We're really usually down in these 3 bullet points at the bottom, where either gamma is too small and this will never be a good idea to invest, there's a unique solution, or there's 2 implied volatilities. And if we look in practice, let's look at kind of quick examples, again, using that Polygon blockchain, delta t is 2 seconds, risk-free rate is 5. And let's assume we said we're going to use 1 basis point fees. Then this delta t bar is approximately 8.5 hours. So we're looking at a blockchain with 2-second intervals, and that delta t bar that we needed the interblock time to be less than here is about 8.5 hours. So order of magnitude's different. Sigma bar is approximately 31%, and gamma star is about 1.5 basis points, which is too large, and therefore, in this case, the fees are too small. A risk-neutral investor should never deposit liquidity, and there does not exist an implied volatility. Doing kind of a bisection search, if we upped the fee level to 1.4116 basis points, then we ultimately find that we have a unique implied volatility of about 44%. But if someone believes that the volatility is anything besides this sigma star, then you never want to deposit. Essentially, we have equality, we get the uniqueness because we have equality of the cost and the value of this option at sigma star, but everywhere else, the value is smaller than this cost. So in this situation, there's a unique implied volatility, but we never want to deposit liquidity unless you believe this is true, in which case you're indifferent between depositing and not depositing. If, however, we go to the 5 basis point fee level that we have from this real pool, we get sigma bar is 158%. Gamma star is 2.7 basis points. So we know there exists 2 implied volatilities. Those are about 6.4% and 310%. So on one side, the 6.4 is the one that behaves the way that we expect. The other one, this kind of really high implied volatility, behaves opposite to what we would expect, but it does exist in the math. So if you believe the volatility is between sigma 1 star and sigma 2 star, then a risk-neutral investor should deposit liquidity. The value is greater than the cost. However, if we're outside of that range, if our volatility is too low or too high, then you do not want to invest. So there's this interesting idea that really there's this range of volatilities that this is a good deal, and if it's outside of that range, this is a bad deal. It just so happens under this 5 basis points with delta t equals 2 seconds, it's a fairly large range. If we turn to looking at the risk of these products, we know the value, and we're going to assume gamma is greater than gamma star. That way, we have that you actually should invest. Then our delta is just gamma over gamma star times the square root of p. It is always positive, so we have a positive delta to this position. We are long the asset, long the risky asset when we become a liquidity provider. Our gamma is negative. So again, this is really nice because, again, our dependence on the underlying price is only through that square root of p term. So we're able to get delta and gamma really easily. So we have a positive delta, but a negative gamma, which tells us something about how we want to hedge these instruments. But perhaps the most interesting to me is our vega. So our sensitivity to the realized volatility. So if we believe that the volatility is changing, how does our value change? And here we do not get a very nice formula. We get some ugly expression because gamma star depended on our volatility. And if we look at this a little bit more detailed, if the risk-free rate is 0, then we have a negative vega, which means that we're actually short volatility when the risk-free rate is 0. However, if the risk-free rate is positive and we're in the world where delta t is smaller than delta t bar, then we have a positive vega when volatility is small enough and a negative vega when the volatility is high enough. This is all completely different than the conventional wisdom of how people talk about AMMs. If you look at the literature of kind of the marketing that is done on AMMs, they talk about it as being a bet on volatility. They talk about this as being long volatility. If you think there's going to be a lot of volatility, you should pool your assets and you collect fees on all of this volatility. But in practice, that's not what actually happens, it seems. What really happens if you look at a lot of these marketing papers that try to sell you on joining into the AMM, they make a lot of very simplifying assumptions on the market construction. In particular, they ignore how the fees are actually being collected. They just say, oh, there's more trading and you collect fees per trade. That's it. That's the end of their discussion. So there is this thing that when we look at this, if the risk-free rate is 0, we are actually short volatility. We are not long volatility, which was very counter to what we expected. If the risk-free rate is positive, then most of the time, the volatility sigma is going to be smaller than sigma bar. And yes, we are going to be long volatility, but it's not uniformly long volatility. There is a point where if the volatility spiked too high, which if we're talking about cryptocurrencies is not out of the realm of the possible, then we can go negative volatility as well, or negative vega as well. And the last point I want to make about the Uniswap v2 world, and I know I'm probably running a little bit short on time, is there's something called the impermanent loss or the divergence loss. This is really the opportunity cost between the buy and hold strategy and depositing liquidity into the AMM. So this plot comes from Uniswap documentation, where they plot out what is this divergence loss from pooling into the AMM without fees. And what you see is as the price changes from where you pulled in, your value drops. You would do better just holding that initial portfolio that you pooled into the AMM than actually doing this. once we add in fees, this is shifted upward, and then you have some potential for profits. So instead of comparing it, just saying there's profits and losses, but we want to actually look at what is the impermanent loss, what is the expected impermanent loss if we invested even just for a finite time. So again, assume gamma is greater than gamma star. Our buy and hold strategy after I blocks, and this is if we assume we're not earning interest, because if we're holding the stable coin, it's like holding cash in your pocket. You're not getting the risk-free rate. So in that case, we have 1 plus e to the minus ri delta t times square root of p naught after I blocks. Or if you are earning the interest, it's just 2 square root of p naught. And the value of the liquidity position is a non-decreasing function in block number, and it is always greater than 2 square root of p naught, which means if it is a good idea to invest, if gamma is greater than gamma star, then you actually have a expected divergence gain. You do not have any expected divergence loss. So that's conditional on this actually being a good deal to invest. It's conditional on having gamma greater than gamma star. But there's one other thing that people have talked about. This is from a news article in 2021 from NASDAQ that half of all liquidity providers lose money to divergence loss. But we just said if this was a good idea to invest, and our previous plot showed if we use the historical volatility, it looks like a good idea to invest. But when we actually look at the distribution of the payouts from this optimal strategy, that we have actually a very highly skewed payout. So we have a few people that will make a lot of money, but a lot of investors will lose money, will have been better off if they had not invested. This is the randomness of it. We're just looking at the expectation, where in expectation you're going to be okay, but that does not mean in probability you're going to have high probability of making a profit. So when we look at this empirically, if we look at the distribution, this actually makes sense. You have expectation of divergence gain, but a large number of investors are going to have divergence loss. And it matches up quite nicely with the fact that in practice, a large number of investors do have this divergence loss. So briefly, and I'm going to go through this very quickly because this is incomplete and I don't have that much time. Uniswap version 3 is called a concentrated constant product market maker. What that means is instead of saying you're just pooling your assets and your assets work between a price of 0 and infinity, you are able to specify an upper and lower price bound so that you're concentrating your liquidity in that range. So ultimately we have, this follows again, this constant product, but we're shifting things by constants alpha and beta. It affects the ratio of the pricing oracle based on the ratio of the assets. And we'll say we're just going to look at a constant lower bound and upper bound. And with that, there's a maximum total liquidity available of X if we're at the lower bound, and Y if we're at the upper bound. And these alpha and betas are dependent on the amount of liquidity available. X and Y we can convert between freely, as long as we know PL and PU. So if we fix these price bounds, we fix the amount of liquidity. The price is, again, our geometric Brownian motion. XT is just following, again, kind of this L over square root of P, but then we need to subtract out alpha. YT, we need to subtract out beta, and the liquidity is including alpha and beta. Generally, we just say, well, let's look at X hat and Y hat, where we add in the alphas and betas again. So now with this concentrated liquidity, you're only collecting fees when the price within this range PL to PU. So instead of just saying, oh, what's the difference between X of I delta T and X of I minus 1 delta T, we need to take minimums and maximums based on these upper and lower price bounds. And again, fees are distributed proportionally. The total value of the AMM gives us sufficient information to look at individual positions. And again, it's this perpetual Bermudan option. We have the cost of the LP token, and we want to figure out what is the value. Our DPP formulation is very similar. It's just a slightly different formula for the stopping criteria and for our fees. But we can still write down what is our expected value of these fees. And it's fairly ugly. We have this kind of long set of equations. I am 95% sure I wrote these up just in the past weekend. I'm pretty sure I have a typo in there somewhere, so do not take these as gospel. But this is the general structure. We can explicitly say what these expected fees, discounted expected fees, are going to be. And they're generally a similar structure to what you'd see in Black-Scholes or what you saw in the Uniswap version 2 construction. Now, because we have these upper and lower price bounds, we do think that there's going to be an optimal stopping. If our price is lower than the lower bound, then we're holding our entire portfolio in the risky asset, which means the value of our portfolio is P times X, where X is a constant, which means under the discounting, we have a martingale. We're not collecting fees, but we have this martingale construction. When we're between PL and PU, then our fees are being collected, so we'd expect that you'd want to continue. But when the price is greater than the upper bound, the holdings that we have in this AMM take value of Y, take this constant number of dollars. And when we discount that, this is a super martingale, which means we would expect there to be some price level P star that's greater than PU, where when the price exceeds that, we want to leave. We want to exit our liquidity position. So we conjecture that the value V of P is Y if P is greater than P star, and this discounting continuation value if P is smaller than P star. We need to actually complete this and actually verify that this is correct and figure out, solve for the optimal P star. But this is our ansatz. This is our guess based on how this behaves in these three cases. The implied volatility, again, so that our value is equal to the cost of pooling. Again, this is independent of the amount of liquidity, but does now depend on the current price, P naught. If P naught is smaller than the upper bound, there will not exist an implied volatility. We're always going to have a better expected profit than the cost would be. So if P naught is smaller than PU, there does not exist an implied volatility. If P naught is greater than PU, we want to solve so that P star of sigma equals P naught. So to conclude, depositing in the AMM constructs a path-dependent perpetual Bermudan option. And determining this implied volatility can assist in finding whether this is a good investment or not. Right now, half of all AMM investors are losing money by depositing liquidity. This allows us to start to look at what are the risks of doing this. What is the fair price? What probabilities do you expect to have if you invested And in particular, we can compute the Greeks, which means if we know our delta and our gamma, we can start hedging these risks so we can reduce the amount of money that is at risk. And one key point here is, again, since that implied volatility was independent of the liquidity and the price, it's really our choice in this is what is delta T, which really comes from which blockchain we want to put this smart contract on. So the choice of blockchain is actually fundamental to figuring out the value of the AMM. So to finish up, some areas where we still want to work on this, some of it within this first paper, some of it for future work. We want to complete our work on the concentrated liquidity to verify our DPP. But also, the constant product market maker is currently the most common AMM. But there are more sophisticated AMMs that exist. There's ones that are made to have more stable pricing, that are made to potentially increase the amount of fees that are collected in different ways. So instead of just looking at the constant product market maker, we can look at other AMM designs. The next point, which I think is very interesting from this perspective, and I'm working on in other directions as well, is right now our implied volatility does not depend on the amount of liquidity in the AMM. Essentially, when I mint a new LP token, when I deposit assets, it does not matter how many other assets are already in the pool, what the size of the reserves are. I'm getting the same number of liquidity tokens if there's $1 million in this pool or if there's $10 in this pool. However, we can update this formula. Instead of saying X times Y is L squared, where L is the liquidity tokens, we can say X times Y is some function of L. And in this way, we can say that there's actually a dependence on the amount of liquidity. So now if as the liquidity increases, we would have a different price of liquidity, which means that our implied volatility will change. If there's small amount invested, the implied volatility will move in one way or the other, will increase or decrease, depending on the function f. So now we can start to have really a market in liquidity. Furthermore, I mentioned how we were looking at this distribution of the fees collected. This really leads in the direction of what's the risk of these positions. So if we start saying we know the distribution, then we can compute the value at risk or the conditional value at risk of these liquidity positions so that we can properly determine what is our risk profile. And then finally, especially when we move to that concentrated liquidity where we have the choice of the upper and lower price bounds, what is the optimal liquidity provision? And we can do this under geometric Brownian motion or other price processes. One that we've conjectured would be very interesting in this direction is the exponential OU process. So number of future directions that can be taken. One fun thing that I really like about decentralized finance is there's a lot of open questions that can directly be used in practice. These are fairly popular products. Uniswap is actually a nearly $1 billion valuation right now. So these are very popular, very sophisticated financial products that are being sold to people. So to understand how to optimally use them, how to analyze the risk, or even how we might better construct these designs is of great importance in practice. So I did put a name of a paper here. The paper is not yet available, but I'm happy to share it once it is completed. Thank you very much.
Well, thank you, Zach, and great to have this hot off the presses here, or ahead of publication. I have been told that even though we don't have a paper yet, we can post your slides and your recording so that people will be able to get access to the information. So
With the caveat that there will be typos in this, I am sure.
yeah, well, there's typos and everything, so it distinguishes you from no one. Even after it's been combed over
Yes.
and combed over, there's always something. But I'm wondering if we have any questions from the audience.
Yeah, I'd just like to confirm my understanding of the structure of the investigation, which I think is, and I know you'll correct any mistakes that I've made. We've observed that the payoffs are consistent with a representation as a perpetual Bermudan option. We then apply now known results for the behavior of perpetual Bermudan options. And in this context, we then deduce a number of interesting results, which we compare with the market reality in order to identify some policy issues as well as some directions for future work. Is that generally correct?
That's generally correct, yes.
Thank you.
As one direction of the future research you mentioned, you wanted to investigate the price process model beyond the geometric Brownian motion. Is there any practical motivation for that direction? For example, is there any practical limitation of assuming the constant volatility in the GBM process?
So the reason that we use the GBM process is we're working under kind of the risk neutral measure. So if we took the exponential OU and then we went to the risk neutral measure, that would again be back to the GBM. So it's really, once we start saying we're an outside investor and we want to do optimal liquidity provision where we have a utility function that we're optimizing, that's when we start saying, well, I have a different price process than this risk neutral price process.
I see. Thank you.
And I'm happy to discuss any of these future works more offline if anyone's interested as well.
Okay, well, that's really great. Last call here for questions.
I was wondering if you have any intuition into why half the investors the AMM lose versus the other win. It's like, seems to me like were they unlucky to invest in AMM and some wrong beginning of that process, or what drives that?
Yeah, so essentially they got unlucky when at the starting time that they had, and that's just from random chance of how the price process evolved from the time that they invested.
But not dependent on the price itself, it's just the timing. Is that what you're saying?
So it's dependent on the price process that evolved. So the realized price process is why they were losing money. Essentially, if we look at, we have our infinite sum of fees. And if we did it on finite time, then in finite time, it's even, you're going to have even more losses because, again, it's optimal to continue infinitely. But if instead of taking this expectation, we just had the infinite sum of the fees. So we don't know what our expected fees are, but we know we have kind of this random collection of fees. We can start looking at what is the distribution of this. So an expectation, we know what it is. But what's the actual distribution? And generally, this is kind of a heavily skewed process. So if our expectation is here, the median might be somewhere back here.
Right. But
So even-
it's still like a basically forward-looking reason. It's not like they invested at the wrong level of the price or the wrong level of realized volatility up till
No.
that.
Correct. It's just bad luck based on how the randomness evolved.
Okay. And is there or are there transaction fees to go in and out of this AMM contracts?
To pull in and to
Yes.
deposit and withdrawal. So yes, there are. Those are what are called gas fees. Essentially, it's the fees to actually execute anything on the blockchain. We've ignored those fees at this moment because those are just fixed fees to enter and fixed fees to withdraw. It would mean essentially it would be a constant that would be added in to the cost of pulling in, and then it would be a cost that would be subtracted from pulling out.
Because in the like just traditional option market, the fees to trade options by itself is also contributing to profitability of any strategy. And they're generally very high.
Mhm.
So I'm just wondering if after doing all that exercises and also subtracting the double or round trip transaction fees in these AMM contracts, is there even more people who don't make any money in this?
Yeah, so that would add to kind of people potentially losing money. I believe when the statistics you see on kind of the news about people losing money, they're just talking about, they're ignoring those fees as well.
Mm-hmm. And is it common that people go in and out of the AMMs, basically trading AMMs actively, or?
So they're in Uniswap V2 in the constant product that we spent most of the time talking about. I believe people held for longer periods of time.
Mhm.
In V3, there are some more sophisticated investors doing what's called just-in-time liquidity provision, where they wait for certain situations where they believe they'll earn the most fees. They invest for a short time, they withdraw, and then they repeat as
Mhm.
necessary.
Okay, yeah, thank you.
Final questions? Okay, well, let's thank our speaker. Zach, that was awesome. I'd like to mention that next week we will be having a seminar that is in person in 648 Evans and also on Zoom. So this is hybrid. You can show up and talk directly with the speakers or tune in from far away. We'll be having Eric Offner, Glenn Rudbush, and Michael Bauer from the San Francisco Federal Reserve, something completely different. So I look forward to seeing many of you then. And thanks very much for joining us today. That was really great. Bye, everyone.
Thank you.